Cash flow makes you rich, but equity makes you wealthy. I think that's one of the most important things to understand when it comes to real estate, yet so many people get stuck focusing only on cash flow. They get into real estate wanting to make a lot of money, gain financial freedom, maybe even quit their 9-to-5 jobs, and they focus almost entirely on how much is going into their pocket each month. Cash flow is great. It's steady money that comes in month after month, but there's a much bigger picture here. And today I want to walk you through 3 powerful ways real estate can build wealth beyond just cash flow. By the end of this video, you'll see that while cash flow is an important part of the equation, there are other aspects of real estate that are just as powerful, if not more so. Also, stick around with me until the end because I'll be sharing a 4th bonus way that can make a real difference to your investment strategy. So let's dive right in. What's up, everyone? My name is fNK&x. I'm a real estate broker here in Toronto. If you get any value at all from this type of content and you haven't already, please hit that like button and subscribe to the channel. If you are thinking of investing here in the city or in the GTA and want to book an appointment with me to have a chat about how I can help you with the entire process from start to finish, I have all my contact information in the description below, and I'd be more than happy to help. Okay, so first things first, let's actually talk about cash flow. Cash flow is the most straightforward benefit of owning a rental property. It's what's left after you take your rental income and subtract all the expenses, your mortgage, property management fees, property taxes, insurance, maintenance, and anything else related to that property. Basically, cash flow is the money you get to keep at the end of the month, and that's what most people love about rental income. You can use cash flow for your own monthly expenses, reinvest it, and use it to pay down other debts. Let's look at a quick example. Say you've got a condo in Toronto that's generating $2,500 in rent every single month. And after paying the mortgage, condo fees, and any other expenses, you're left with $300 a month in cash flow. That $300 a month or $3,600 a year might not seem like life-changing money, but if you were to build a portfolio with multiple properties producing this kind of return, it could eventually replace a significant portion of your income. This is one of the biggest reasons people are attracted to real estate, the idea of passive income. Over time, cash flow can give you that kind of financial freedom that lets you choose how you want to spend your time. But as much as I love cash flow, it's just one part of building wealth through real estate. The reality is that with today's prices and interest rates, most real estate investments, especially long-term rentals, will likely be cash flow negative unless you're able to make a big enough down payment to reduce the mortgage or loan amount as much as possible. And I'm not talking about short-term rentals or house hack setups like duplexes or triplexes, just a straightforward long-term rental where you buy a property and lease it to one tenant for a long period of time. In most cases right now, these types of investments won't generate positive cash flow, not right away at least, and that's totally okay. Many investors might see this and walk away, but as I mentioned, cash flow is just one part of the equation. As we explore the other benefits in this video, you'll see how an investment that's cash flow negative might still be well worth it. Now, that's not to say that any property is a good investment, even if it's cash flow negative. You still want to minimize those losses or look for creative ways to boost income if possible, like opting for multi-tenant properties, for example, like duplexes, triplexes, or even a home with a separate walkout basement. These options in our current market can often turn your cash flow around to the positive side, but it's not necessarily make or break in determining whether an investment is worthwhile or not. Positive cash flow is definitely beneficial, and it can make holding onto the property much more manageable, since any sort of negative cash flow will technically come out of your pocket, but it's still just one part of the equation. As we go through the other ways real estate builds wealth, you'll see that a property can still be a strong investment even if cash flow isn't the primary benefit, not in the beginning at least, and you'll see why later. This brings us to the second way real estate builds wealth, and that is appreciation. Appreciation is the increase in a property's value over time. On average, property values across Ontario tend to rise by a certain percentage each year, though this can vary significantly depending on the city that you're in, as well as the type of property, whether it's a condo, a townhome, or a single family home. In Toronto specifically, we've seen appreciation kind of fluctuate over the years, and while this can differ based on your specific location and the current market conditions, real estate in major cities like Toronto have historically appreciated faster than the national average. And again, when we talk about average appreciation, I use that word average. This means we're talking about the appreciation over a period of time. Generally, the longer, the more accurate the average may be. So let's say we're looking at a 10-year average, and the average appreciation over that time is 5%. So 1 year you might be up 5%, 1 year you may be up 1%, and then another year you may be down 2%. But overall, if you own the property for that entire 10-year stretch, you'd have made on average 5% per year on your property value. So going back to our example, let's say this condo you bought in Toronto cost you $550,000. If it appreciates at 5% per year, in 5 years, the value would have gone up to roughly $700,000. That's an increase of about $150,000. And that's without you doing anything besides owning this property, even if you owned it and didn't rent it out. That $150,000 is essentially wealth that you've created passively thanks to appreciation. When you combine appreciation with cash flow, you can see how the gains start to multiply over time. This is one of the biggest advantages of real estate over other types of investments. It's a relatively steady way to build wealth, especially if you're in a city like Toronto or really anywhere in the GTA in an area with high demand for housing and a limited supply of properties. Now, if you're wondering what actual appreciation rates look like in the GTA, let's take a look at the last 10 years. For detached homes, the average price went from around $950,000 in 2014 to about $1.8 million in 2024. That's a total appreciation of about $800,000, which works out to an annual appreciation rate of about 6.45%. Now let's look at condos. Condos averaged about $390,000 in 2014, and now they're around $720,000, which is a total appreciation of $330,000, or about 6.33% per year. Condos historically do not do as well as single family homes, but the average appreciation here is very similar to detached homes over this 10-year stretch. This average includes everything that's happened over the past decade, the impact of COVID, significant rate hikes we saw over the last few years, and other market fluctuations. So when we're looking at appreciation in the GTA, a little over 6% per year has been the norm. As a side note, if you're considering investing, you usually do want to find out the average appreciation for your specific area and property type to get a clearer picture. For example, if you're thinking of buying an investment property and you're looking for a detached home in Whitby, you can find that exact appreciation for that location and type of home specifically. If you're thinking about investing in real estate and are curious about a specific location or property type, you can reach out to me using any of my contact information below, and I'd be more than happy to run the numbers with you. Now, appreciation might not be something you see right away. It takes time, and you can't access that increased value until you sell the property or refinance it. But over the years, it's an incredibly powerful part of building wealth through real estate. And when you think about this example condo going up in value by $150,000 over 5 years, you start to see how real estate can lead to significant long-term growth, especially if you start to scale up. Imagine doing this 2, 3, or even 4 times. The numbers begin to multiply, and that growth becomes exponential. With each property, you're building more equity and creating a stronger financial foundation. And that takes us to the third way to build wealth through real estate, and that is equity buildup, which happens through debt paydown. This is essentially where your tenants help you pay off the mortgage on the property. As they're paying rent each month, you're using that rent to cover the mortgage payments, which gradually reduces the amount you owe. Every payment you make on the mortgage builds up your ownership in the property, which is called equity. So unlike renting where you're just paying a landlord, with real estate, you're putting money into an asset that you increasingly own over time. Even if it's a property that you live in, as you pay the mortgage, you're building equity over time every time you make a mortgage payment. So again, let's go back to our example condo in Toronto. Suppose you financed it with a $400,000 mortgage at a 4.5 interest rate. Each month, a portion of that mortgage payment goes towards the principal, meaning it's paying down the amount you owe. Over the course of 5 years, you may have paid down around $50,000 or more in principal, depending on your mortgage terms. This $50,000 is equity you've built up, which adds to the value you own in the condo. So not only is the condo appreciating in value, but your debt on it is also decreasing. That gap between what the property is worth and what you owe on it is growing, and that's your equity. This equity buildup, again, like appreciation, might not be cash in your pocket right now, but it's money you'll receive when you eventually sell the property. And the longer you hold onto the property, the more that the equity grows, especially as appreciation and debt paydown work together. Over time, this equity can become a huge source of wealth, especially if you reinvest it into more properties. Also, as your equity builds, your loan or mortgage balance decreases and your mortgage payments may start to go down as well, especially when it's time to renew the mortgage. This means that over time, even though you may have started with negative cash flow, your cash flow could turn positive since your biggest expense, which is your mortgage payments, will gradually decrease. In the long run, this shift can significantly increase your monthly income from the property. So here you can really see how this third way to build wealth through equity actually works in synergy with your cash flow, and how all three really can start to work together to exponentially help you build wealth through real estate. But wait, just as I promised, there's one more bonus way to build wealth through real estate, and that's through the tax benefits here in Canada. One of the key advantages of owning an investment property in Canada is the tax benefits available to you as a property owner. First and foremost, as a rental property owner, you can deduct a range of expenses directly related to managing and maintaining your rental property. These deductions include costs like property management fees, the interest on your mortgage payments, property taxes, home insurance, utilities, any maintenance fees, even car expenses related to you driving back and forth to your rental property. Pretty much anything related to owning this property and using it as a rental can be deducted. By reducing your taxable rental income, these deductions allow you to keep more of the money you make from your property. And again, even on top of that, any expenses incurred to advertise for tenants, legal and accounting fees, and even certain repairs and renovations are also often deductible, making it even more cost-effective to manage the property. Overall, these deductions help make the property more profitable by lowering your annual tax burden, allowing you to maximize your income while continuing to build equity in the property. When done carefully, these tax benefits can be a very powerful tool for increasing the long-term returns on your real estate investment. Going back to our Toronto condo example, let's say you're making $3,600 in cash flow each year from this property. After deducting your mortgage interest, property taxes, management fees, and any other allowable expenses, your taxable income from the property might drop to say $1,000 a year, or even zero, or even negative return. Remember how we talked about negative cash flow and how it still might be worthwhile? Well, now alongside the appreciation and equity buildup, you may also be able to claim a loss, and this amount will be taken off your personal income tax and may actually reduce the amount of taxes you owe at the end of the year, or even result in a refund. Again, I'm not saying you're aiming for negative cash flow, but in the case of taxes, you most likely will get some money back. So these tax benefits mean that you're able to keep more of what you're making, reinvest it, or put it toward other expenses. This is a key reason why so many people turn to real estate for wealth building, because the tax system here in Canada is relatively favorable to real estate investors. So to bring this all together, cash flow might be the most obvious way to make money from real estate, but it's only one part of the picture. When you combine cash flow, appreciation, equity buildup, and the tax benefits you receive, you're really leveraging 4 powerful ways to build wealth. Over time, these work together to generate significant growth in your net worth, and that's how you get from just a single property to a substantial portfolio of assets. Real estate allows you to turn a monthly income into long-term wealth. When I started out, I was focused mainly on cash flow because that's the part everyone talks about. But as I learned more and started seeing how the other elements contributed to my wealth, I understood that the real power of real estate is in how all these factors come together. If you're looking to start, don't just focus on monthly cash flow. Think about how appreciation, equity, and your taxes will play a role in building your wealth over time. That's where real estate goes from being a source of income to becoming a powerful tool for long-term financial security. Thanks again for tuning in today. If this was helpful, please hit that like button and subscribe for more content like this, and drop a comment with your own experiences or if you have any questions. Let me know if you'd like me to break down any of these topics in more detail, and I'd be more than happy to help. Real estate is a journey, and I'm here to help you every step of the way. You can reach out to me using any of my contact information below, and I'd be more than happy to chat. Thanks again for watching, and I'll see you guys on the next one.